Welcome to this Expert Explainer. Today, we're totally deconstructing the exact granular mechanics of heavy vehicle tax optimization. We are skipping the surface-level fluff entirely. Instead, we're looking purely at actionable insights, the underlying mathematical formulas, and those strict legal frameworks that actually govern this space. Based on extensive, anonymous expert reports, we're going to examine how specific, non-obvious sections of the tax code interact to create massive leverage for you as a business owner. If you want to understand exactly how a physical asset, like a heavy vehicle, converts into immediate compounded tax relief, well, you're in the right place. Because mastering this cause and effect relationship can literally be the difference between suffocating your cash flow and rapidly accelerating your business growth. All right, let's dive right in. So just taking a quick look at our agenda, this analytical breakdown follows a strict logical path. We're going to define the bonus mechanism, verify the weight threshold, break down the proportional math, explore code synergies, define the correct ownership structure, and then finish up with strict risk management.
All right, Section 1, the bonus mechanism. This is all about accelerating deductions. To really optimize the tax code, we first have to thoroughly understand the baseline timeline we're actually overriding.
So, the crucial mechanism here is timeline compression. Fundamentally, bonus depreciation alters your immediate cash flow projections. Normally, when a business acquires a major physical asset, the tax code forces this really slow, multi-year recovery of that cost. You definitely don't get the tax benefit all at once, which basically keeps your capital locked up tight. But bonus depreciation? It acts as a massive accelerator. It allows you to recognize a huge percentage of that expense immediately, right in year one. Let's be clear, this isn't just some clever accounting trick. It is a literal liquidity engine. It directly frees up capital up front, giving you an immediate influx of cash flow that you can instantly reinvest back into the operations and the survival of your business. Now, there's a really stark mathematical contrast between traditional capital recovery and these immediate write-offs. Under the standard system, MACRAs, a vehicle's cost basically bleeds out over a rigid 5-year period. It's kind of like sand slowly, painfully draining through an hourglass. It just continually delays your tax relief. But 100% bonus depreciation changes the game entirely. It acts like a rocket, completely collapsing those 5 years of delayed relief into a single high-impact event in year one. The operational cause and effect here is just profound. By legally recognizing that massive expense up front, you drastically lower your immediate taxable income, which means, effectively, you're keeping that capital secure in your treasury rather than just handing it over to taxes. However, you got to pay attention here because this mechanism is strictly bound by time. Expert analysis makes it clear that this timing rule is absolute. Recent legislative updates restored this 100% level, but the asset must be actively placed in service after a very specific date, January 19, 2025, to trigger the full yield. And placed in service is a critical legal distinction. It means the vehicle has to be physically ready, available, and actively used for its designated business purpose. The IRS deliberately enforces this specific distinction to stop business owners from executing, paper-only transactions on December 31st just to harvest a quick deduction. You absolutely cannot just sign the purchase paperwork and leave the truck parked on the dealer's lot. The operational reality must align perfectly with your legal claim.
Moving on to Section 2, the weight threshold. Here, we're classifying the asset, because the tax code actually categorizes physical assets ruthlessly based on their literal engineering.
This single number, 6,000 pounds, is the absolute legal threshold. A gross vehicle weight rating, or GVWR, that exceeds 6,000 pounds legally shifts a vehicle from standard constraints right into a specialized, high-yield deduction category. The implicit assumption baked into the tax code here is that vehicles over the specific weight are inherently industrial or commercial tools. They're viewed entirely differently from lighter passenger cars. The IRS actively suppresses those lighter cars with really strict luxury auto depreciation caps. But by crossing this exact 6,000-pound threshold, you completely bypass those luxury caps and unlock enterprise-level deductions.
Now, as stated in expert reports, meeting these specific criteria is completely non-negotiable for unlocking the maximum allowable write-offs. We are talking about heavy-duty pickup trucks, dedicated cargo vans, and large SUVs. And here's a crucial non-obvious detail. The code applies to both new and used vehicles as long as they are new to the specific business entity that's claiming them. Furthermore, the asset inherently must have a recovery period of 20 years or less. So why does this specific rule even exist? Well, it's to cleanly separate vehicular assets from long-term real estate or land improvements. It ensures this rapid acceleration only applies to rapidly depreciating physical equipment.
Okay, Section 3, Proportional Math. We need to look at calculating business use because this aggressive strategy is strictly bound by operational reality.
To even qualify for these advanced depreciation mechanisms, your vehicle's usage must cross this strict minimum threshold of 50% dedicated solely to business operations. Make absolutely no mistake here, this is a cliff. If your business use is proven to be 49%, the entire advanced strategy collapses instantly. You are completely disqualified from leveraging bonus depreciation. 0. You have to empirically prove that the absolute majority of the vehicle's mileage is driven directly for revenue-generating activities.
The operational math is completely explicit. Your proportional business use acts as a strict multiplier against the total asset cost. Let's say you acquire a $75,000 qualifying heavy vehicle and you use it exclusively, 100% for business. Well, your potential year one deduction is that full $75,000. It's a one-to-one match. But if you blend personal and business use, let's say at a 75% business ratio, your deduction is capped exactly at that proportion, yielding $56,250. And as we literally just discussed, dropping to that 49% mark yields absolute zero in advanced deductions. The mathematics governing your cash flow in this scenario are absolutely rigid.
Now, it is absolutely critical to understand that to utilize bonus depreciation, you have to elect what's called the actual expense method. You're permanently abandoning the simpler standard flat rate mileage deductions. Look, the standard mileage rate is designed for simplicity, sure, but that simplicity severely limits your maximum yield. By opting for the actual expense method, you are actively choosing complexity to unlock a much higher value. This means you are legally obligated to meticulously track every single dollar spent. We're talking fuel, commercial insurance premiums, preventative maintenance, tolls, parking fees, specific part replacements, and crucially, the calculated depreciation itself. You then apply your business use multiplier to that massive final sum. Choosing complexity is literally the necessary price you pay for the tax break. Let's jump to Section 4, Code Synergies. We're talking about compounding tax mechanisms here. Because sophisticated tax optimization doesn't just rely on a single rule, it relies on the legal synergy of overlapping codes. Here is the exact synergy that expert practitioners use. Section 179 acts as your foundational layer. It allows you to expense a fixed dollar amount immediately. For these specific heavy vehicles placed in service in 2025, expert reports highlight that the Section 179 limit is capped at $31,300. Now, by itself, that cap obviously leaves a huge portion of a heavy vehicle's cost undeducted. But here is the mechanism of action. Bonus depreciation steps in as the uncapped mechanism to absorb whatever is left of the vehicle cost. By stacking these two provisions sequentially, the entire asset cost is effectively neutralized against your taxable income. These two distinct legal mechanisms work perfectly in tandem. First, the Section 179 cap absorbs that initial $31,300. Then, bonus depreciation acts like an infinite sponge. It soaks up the remaining balance, whether that happens to be another $20,000 or another $80,000. Together, they completely eliminate the taxable burden of the heavy asset acquisition. It just proves that understanding the specific sequence of the tax code is honestly just as vital to your wealth preservation as understanding the code itself. Moving right along to Section 5, Ownership Structure, LLC versus personal liability. Because let's be real, a massive tax deduction means absolutely nothing if the asset introduces a severe liability vulnerability into your life.
Both structures legally permit the deduction as long as your business use is verified, of course, but expert analysis strongly highlights that placing a 6,000-pound moving physical asset under an LLC provides critical risk insulation. Think about it. If you own the heavy vehicle personally, a business-related accident leaves your personal home, your personal savings, and your investments entirely exposed to potentially devastating litigation. However, titling the vehicle directly in the LLC's name establishes a crystal clear legal boundary. The vehicle becomes a corporate asset. This creates the all-important corporate veil, a vital legal shield. In the event of a commercial lawsuit, plaintiffs are generally restricted to pursuing the LLC's specific assets, not your personal treasury. It's just a fundamental element of advanced risk management.
Finally, Section 6, Risk Management. Surviving strict IRS scrutiny. You absolutely must aggressively build your defense before you ever even file the claim.
This quote is a stark, unavoidable warning from expert reports. The underlying economic reality of your business must justify the asset, entirely independent of the tax code. If you operate an online consulting firm from your living room sofa, well, acquiring a 7,000-pound industrial dump truck completely lacks a defensible economic rationale. The tax code is designed to incentivize necessary business investments, not to subsidize irrelevant lifestyle purchases. If the vehicle isn't truly required for real, actual revenue generation, you can bet the entire deduction can and will be aggressively disallowed during an audit. If you are going to leverage this aggressive strategy, you absolutely must strictly follow these 4 steps to convert your claim from just a simple number on a form into an unassailable legal defense. First, you have to establish the operational necessity. Why do you need it? Second, ditch the analog pen and paper logs. They constantly fail under scrutiny because IRS algorithms easily flag them for human inconsistencies. You must deploy digital, time-stamped mileage tracking software to empirically prove your business use percentage. Third, immaculate retention of purchase and service date records is mandatory to prove your timeline eligibility. And finally, the vehicle must be purchased and maintained exclusively through a dedicated business bank account. Commingling your personal funds instantly pierces that corporate veil we talked about and completely invalidates your structural protections. As we wrap up this explainer, I want to leave you with this final provocative thought. It's vital to ensure your tax optimization strategies remain mathematically sound and legally compliant. Advanced bonus depreciation for heavy vehicles is a tremendously powerful tool. It acts as a direct multiplier for your cash flow and an incredible accelerator for your growth. But it demands absolute operational discipline, pristine documentation, and a genuine business use case. Apply these frameworks rigorously and ensure your business is operating at its maximum mathematical efficiency. Thanks so much for joining this explainer.